Good morning, James.
Morning, James.
Thank you very much for doing this again. I think it's about over a year since we did it last time. But nevertheless, could you just sort of start off by running through what Edinburgh Trust is doing and how it's being managed and what it's trying to achieve, please?
Absolutely, James. So I'm going to canter through this at some pace and we can come back to points on questions if you wish. So first slide, I love having first slide as performance. You can see here, since we've taken over the mandate in the teeth of COVID, on the right-hand side, the numbers there, you can see in absolute and relative terms, they are distinctly respectable. And I think it's worth bearing in mind there's loads of different chapters that we've had to adapt to in that period. So next slide, please. This is a dry old slide, but sets out the objectives and the like. What I'd say about this is, the twin objectives, we've met one, not met the second, but actually by achieving a good total return, I would argue actually that we've done a tolerable job, if you like, against some quite elevated inflation over this period. How we've done it? Well, we've done it by employing the same style that we've done for some time, which is this flexible, so no enduring bias towards growth or value, and a focus on total return, which is basically not prioritizing or bias the portfolio to income at the expense of capital. And, we're lucky enough to have a good team who spend their days really looking at the guts of companies, the strategic positioning, and very much ESG is integrated throughout. Risk, as you'd expect from a business like Liontrust, top quality. We've got, I think, the right bias of number of stocks, 40 to 50 stocks, with a bit of a rifle shot of sort of non-UK listed stocks where appropriate. And then as the board did an RNS in the last month or so, they've announced that I've decided to retire in early 2024, and Imran Sattar, who I've worked with not only at Liontrust and predecessor companies, but also back in the day at a firm called Mercury, is to become the next portfolio manager. But the key point is he will be ploughing the same type of process from the same team. Next slide, please. So investment approach, pretty simple. Again, we can come back to this in questions, but we spend about a quarter of our time looking at the macro. So if I put this in the perspective of like a company like Tesco, which I met yesterday, had results last week. I think what you've got here is obviously it's a pretty competitive environment, but what we've got is not undue capex coming in. We've got disinflation coming through, and that's actually not a bad backdrop for Tesco to plough its strategy of, if you like, nibbling market share from all players. And I think it's doing that by a pretty clever strategy, as you know, the Aldi price match, which anchors value, and then the club card piece, which is, if you like, sort of icing on the cake. And the good thing about this one is I think that the forecasts are very doable. Expectations are low. This is a business that calibrates its profits in a way that works for society. So I would say ESG is integrated. And what it's also got is a future facing part to the business, which is obviously Clubcard, which reaches some sort of on the app 16 million people, and obviously the digital sort of card side a further 7. So what we've got is a business that's future facing and a bit of a parable for the UK. And James, you alluded to this when you were talking about the European trust. I mean, UK companies are cheap. This is a perfect example, which has a high free cash flow of just a whisker under 10%, distributing 4 by dividend and 750 million per annum a minimum in share buybacks. So we've got one of our top 5 active positions. Next slide, please. So this is This is really just an illustration just to show, I think, how much has changed really since we last did one of these. I mean, this was encapsulated the feeling, if you like, of the time on the left-hand side in November last year. And next, where we are currently is the news has improved a lot. I've taken this from the Lloyds Bank Business Barometer. It's a long-running series. I could have taken the GfK data, but what it shows is the consumer confidence in GfK is better, and business confidence here in the Lloyd's survey is better. And that's just a good enough environment for us as a team to find companies that are on the strategic front foot, gaining share and showing blue water in terms of their sales growth relative to pre-COVID. Next slide, please. This is just a bit of an advertorial, if you like, for the UK equity market. And those of you listening who are, nicely close to markets will be well aware of this, but it still, I think, warrants the advertorial, which just really shows that the UK is in free cash flow. So this is next 12 months free cash flow taken from Goldman's, shows that it is highest amongst the international universe. And even if you adjust for the fact that, yes, we have quite a lot of banks which are relatively low growth, or international energy companies which are cyclical, arguably, this still wouldn't change necessarily the absolute shape of the left-hand graph. And the right-hand graph is also just showing that actually a lot of that cash is coming back to shareholders. So you can see the dark blue is the dividend yield, the light blue is the share buyback, and the red or orange is the combo of those. You're getting a decent amount back. And, I'm often asked in meetings, so, what's the catalyst for the UK equity market? Well, in essence, what is happening, as we know, is there's a lot of selling by retail and wealth managers of the UK as they respond, I think, to the growing weight of the MSCI in the overall index. And what we are seeing is actually companies take the other side of that, and I'd much prefer to be on the side of companies than the former. So next slide, please. This is just a little flavor, if you like, of what we've been doing over the last 12 months, and we can very much come back to this if listeners wish to focus on any of these. But just I think a nice little illustration might be that, a Reckitt was sold and we bought Haleon. And I think Haleon, in a way, speaks volumes, because the press is all about UK companies moving and relisting to the States. Here is a picture of a company that has demerged from Glaxo, decided to list on the UK stock market. What it also was, and we really like demergers relative to IPOs, because they tend to be much, much less juiced. And in this instance, it actually was demerged at a time where there was almost an orchestrated fear around Zantac liability. So it gave us a good opportunity to buy into a peach of a business. And why I say peach of the business is that this has got fantastic brands in some very strong growing areas. So if you look at consumer healthcare, a lot of them are struggling to grow volume. This actually is growing volumes nicely. The last figures were sort of 3% volume and 6-7% price. Contrast that with Reckitt's negative volume. So, this is chalk and cheese, and Haleon listed. The laundry list of things people don't like about it focuses very much on debt, but actually this is a business with strong momentum, strong white space, and one we've been buying a lot of in the last 12 months. Next slide, please. So this is a slightly complicated slide, but what I'm really trying to show is, for us as a team, if we're looking to endeavor to outperform in most chapters of the market, I think you need a number of themes in a portfolio. You need to layer it. You need to be flexible. And so what I've done is labeled this and thought about the sort of various themes that are in there. And again, we can come back to this in questions, but one of them I would highlight is Darwinism. So this idea that against a pretty tough environment, but an environment where the pulse is a bit better, actually the market share that accrues to the number one and two in a market is outsized. So just think Premier Inn. Think about Premier Inn's competitive set prior to COVID, and think about it now. Travelodge, frankly, pre-pack waiting to happen again, probably. Then you've got the independents all struggling with gas bills, and the field, if you like, is open for the likes of Premier Inn. I put down ESG rehabilitation, which we can come back to, but here the key point is that this isn't a static thing, is the key thing I would say. And you think about that through the lens of the banks, or indeed the defense companies, which arguably are very important for things like SDG 16. So next slide, please. This is a curiously dry slide, but what I'm really trying to do is just show listeners what are the size of the active bets that we have in the portfolio. And we can come back to any of the any of these that you wish. And what I'd also say is that what we also have, so then the other on the bottom left, you can see that we have 8% in non-UK listed shares, which are all rifle shot using our global team. So the likes of Publicis, for example, in media and transformation, Intel, for example, or Novartis in pharmaceutical, to name but three. Next slide, please. So in terms of summary, really what we're at is we're at the past the 3-year proof point. The numbers, as I showed on the first slide, are reasonable, and both in relative and, more importantly, in absolute terms. And what makes us excited about this trust at this juncture is that it's invested predominantly in the UK, where valuations are standout. And if you access this through the trust, you, if you like, get discounted shares, so UK equities at a discount as well. So I think of that as a double discount, if I'm honest. So I will pause for questions there. James, over to you.